Welcome everyone to our debt repayment webinar, your guide to getting out of debt. My name is Letitia Taylor Smart, and I'm the Director of Alumni Career and Personal Development with VCU Office of Alumni Relations. Before I turn it over to our wonderful moderator, Carolyn McCray, for today's conversation, just wanted to go over just a few housekeeping points. We will be recording this evening's event, so don't worry if you blinked a little too hard and missed a few seconds of the discussion. A recording will be available for you. There's also live closed captioning that you should see available at the bottom of your screen. If you have any issues accessing that feature, please message me for assistance. Let me know. Also, I would like to thank those that were able to submit questions for our presenter while registering. We're going to try to get to as many questions as possible that you may have, but feel free to submit questions even as you think that you might have questions even before going into the presentation, or as Lindsay presents this evening, any questions that you might have, whether you want to put them over in the Q&A pane of the control panel or on our chat feature, that will be great. And we will get to those at the end if time allows. So without further ado, I would now like to turn it over to our moderator, Carolyn McCray, Director of Financial Wellness with the Virginia Credit Union Financial Success Center at VCU.
Thank you so much, Letitia. Happy to be here. I have the privilege of introducing all of you to our presenter, Lindsay Breitmeyer, our personal finance coach for today. Lindsay is a Dave Ramsey preferred financial coach who is pursuing her dream of helping people with their personal finances. Her passionate teaching and speaking style motivates clients to reach their goals. Lindsay is married with one little one and one on the way and resides in Glen Allen, Virginia. So tonight, Lindsay is going to walk us through tackling debt. One of the most common financial goals in the US is to become debt-free, but most of us are overwhelmed with the thought of where to start. So Lindsay's presentation on tackling debt will not only teach us how to quickly pay off debt, but it also provides inspiration and hope on how becoming debt-free can be a reality. Lindsay, thank you so much for being here. And with that, I will let you take it away.
Wonderful. Well, thank you guys for having me tonight. And as the beauty of technology, we're just going to roll. And if there's anything that happens, just put it in the chat and we will try to get that all straightened out. So I'm going to share a PowerPoint presentation and we are going to go from there. So just give me 1 second. All right. All right, you guys, everybody. If you can't see it, now is the time to say something, but hopefully we'll get started here and we'll get rolling. All right, so we're going to start today with talking about tackling debt. It really is a monumental topic. It can be overwhelming, it can be scary, but the opposite side of it, being debt-free, can really be life-changing. I speak from experience. I'll tell you a little bit about me, just so that you know kind of where I come from. I am a Richmond local, born and bred. I have many relatives that have graduated from VCU. I, however, graduated from Randolph-Macon, just up the street. And I came out of college with student loans. I had all sorts of debt, automobile loans, a little bit of credit cards, some medical stuff, typical for a 24, 5-year-old by that point. And then I started researching, the work it would take to become debt-free and how that would change my life. And I am happy to say that after 4 long, hard years of work, rewarding yet hard, my husband and I together successfully paid off over $157,000 in 4 years. That was a mix of student loans, vehicles, credit cards, just everything that society can throw at you, we had a little bit of. So I want to say that from a place of I've been in debt, I've been where many are, I have worked the plan, I have worked the path, and I get to be on the other side of it now to share hopefully that encouragement and that wisdom, and also just be somebody who can walk along that journey with you to say, it can be done. It's not always easy, but it can be done. So I just wanted to let you guys know that I'm not over here sitting on millions of dollars one day, hopefully, but I do have the title of being debt-free, which is a piece that can't be put into words coming from having that much debt hanging over our heads. So I'm going to move forward with the slides. And again, we'll take a couple breaks for questions. So if you have something, write it down, send it in, and then we'll try to get through what we can. So today's topics, we're going to talk about perception versus reality. Basically, what does society say about credit and wealth? And what could be what are some of the things we think about versus what's really kind of the meat and potatoes of the issue? Our second topic is going to be tackling debt. We are going to give you a step-by-step process that will help you eliminate debt faster than you think is possible. Lastly, we will hopefully motivate you to get this done and make an improvement in your financial situation. Regardless of your income, regardless of the position we are in, we can all look to improve. And if there's ever been a catchphrase for this process, it is that it is a marathon and not a sprint. Depending on the level of debt or the level of things you have to work through, it is doable, but don't think it's going to happen overnight. It will take some hard work, but it is so worth it and so rewarding. All right, so we're just going to take a look at the screen real quick and say, these might be some of the reasons that you want to improve. You have to have a why that is strong enough, and then the how will happen, but it must be driven by your why. Why are you here? Why do you want to improve? We get so caught up in life that we sometimes lose sight of our why. So just take a couple seconds, look at this. This is not all encompassing, but it might be some things that are important to you. Write it down and just try to hang on to that mindset of, why do I want to win with money? Why do I want to win with getting out of debt? I will just tell you, personally, for me, it was peace, it was relaxation, it was my long-term health, it was early retirement. I would love to retire someday. The future of my family. There's lots of different things and lots of different seasons that we go through, but those are just a couple. So take a look at that, write down a couple that might be something that's important to you, and we will keep going. All right, our reality check. 30% of employees have 401k loans. Another reality check. We owe more on student loans now than we do on credit cards. This turned around 2010, where that became the leading debt, decision, factor, and that credit cards kind of took a backseat to student loans, and student loans have continued to skyrocket, even so in today's society. Another reality check, that 39% of employees have trouble making timely credit card payments. We all have this warped illusion of what doing well means. And this is just going to be the next slide is a funny commercial. It's kind of old, but it is hilarious. And I quote it often. My family quotes it often. And hopefully you guys will think it is entertaining.
Lindsay, I think we have an audio issue with the commercial.
Okay.
Yeah.
All right. Well, you know what? We will just take it and keep on going. It is a funny old commercial that talks about all of the things that society tells us are important. So a new car, that 4-bedroom, 2-bath house, the animals, the riding lawnmower, the perfectly manicured grass, the golf club membership, all of these things. And at the end of the clip, the guy is riding on his wonderfully manicured lawn on his lawnmower saying, "I'm in debt up to my eyeballs. Can somebody please help me?" And it's just that the perception in our society is that this perfect picture is not always so perfect. The grass is not always green on the other side. The grass is greenest where you water it. So just kind of keep that in mind, that society and what we see on TV and on the internet and in magazines is not necessarily healthy. Not saying it can't be, but just remember that what we see is not always the true whole picture. It's kind of what people say nowadays about, Instagram. Nobody posts their horrible photos on Instagram. We only post the really nice ones because you want to feel good about stuff. You don't want people to see the backside of your of your life almost. So let's keep going. And we'll just kind of, we're going to skip over you, Stanley. Okay, perception versus reality. We kind of talked about that. We're going to keep going with that. And we're going to talk about some of our favorite debts. I would be curious what your favorite debt might be. There's a couple of, there's a handful of very common debts here. Student loans, lines of credit, home equity, credit cards, timeshares, vehicles, overdraft protection, boats. It's weird to say that we have favorite debts because really the best debt is one that is paid off. And I kind of told you guys about my story, but it may take a while for people to catch on. You have to get your feathers ruffled. You have to get your toes stepped on, but the process works. When you work to get out of debt and you work to not get more debt, there is financial freedom on the other side. So hopefully we can kind of take this misconception about good debts and bad debts and favorite debts and just say, maybe no debt is the right answer. And that way you can use your paycheck to pay for things that you enjoy or dreams that you want to accomplish. So let's go we're going to go on to some perception versus reality. So number one, no more debt. The perception is that it's okay to borrow money and go into debt. The reality is there's no such thing as a good debt. Not even for a new car or any car. We are going to show you how to save and pay cash, and more importantly, why to pay cash and avoid debt. Number two is the credit score. This is one of the hottest topics in personal finance. The perception is a high credit score means that I am winning financially. But the reality is that having a good credit score just means that you are good at handling your debt. Moving forward, we're going to talk a little bit about the credit score. The perception is that if you have a high credit score, you have wealth. If grandpa leaves you $5 million, guess what? Your credit score doesn't rise. Here's how the credit score is calculated. If you get a raise, does that improve your financial health? It all comes down to these different pieces of the puzzle that say you have level of debt, your payment history. Is it a new debt? Is it an old debt? How long have you had it? There's different types of debt. So this all goes into what makes up your credit score. All right, so the third one is credit cards. The perception is that it's convenient. You get airline miles, you can use it for an emergency. It's safe. You can't do things without a credit card. But the reality is that debit cards are really great and cash works better. Once you pay for something in cash, you don't have the bill coming to you in your email or in the mailbox at the end of the month telling you how much you spent. The average person spends 12 to 15% more using credit cards than they do debit cards or cash. We are not against the cards, especially debit cards, but we do recommend using cash because it is an emotional trigger. When you have to pay cash for something, it tells your mind that was painful and I have to exchange my cash for the product I'm receiving. So basically the note there is, debit cards are better than credit cards, and cash, when you can use it, helps you spend less. Number 4, overdraft protection. This is that really cool product that will protect you from the overdraft fees. But the reality is that if you overdraft your account, you still pay fees. This is simply a lack of planning, and the bank loves it. It's one of the main revenue generators for banks. As a matter of fact, banks made $12.4 billion in 2020 on overdraft fees. So while you might not have to pay the overdraft fee, you are still, by borrowing money to cover those fees, you're still paying fees and you're still paying interest on those safety nets. All right, moving forward, the car. Perception, driving a new car is safer, it is more reliable, and it will save you in the long run. But the reality is that paid for cars free up money to build wealth. Most people simply give excuses, but listen to this story about somebody who has their why in front of them. And it basically talks about the story, could be anybody, but it says, when we picture a paid for car, we say, gosh, I bet this is the paid for car that you all had in your mind. Some 1970s, 80s beat up something. You don't even know. It's an ugly color and you don't want to drive it anywhere. But the reality is that you can have a paid for car that looks something like this. This is a $1,000 car, literally off of a Facebook Marketplace ad. Granted, used cars are a little bit inflated right now, but you get the idea. This is a great used car. It has it's safe, it has reliable tires. It may not be pretty, but it's going to get you from A to B, and it's $1,000. For people who need to have a little bit more space, there's a minivan. I mean, this took 3 minutes to find online. It was $5,000, $4,900, with a little over 100,000 miles. And it has a 4 out of 5 star crash and reliability rating. So excuses can be part of the past, but if our why is strong enough, it is okay to drive cars like this for a short time period in order to free up cash to accomplish our dreams of paying off debt or saving for a nicer, newer car. I can tell you now that I drive a paid for car. It's a 2015, but in the lot next to all the new cars, it would be just fine. And it is wonderful to not have a car payment every month. The average car payment in America right now is $464 a month for at least 60 months. So imagine taking that $460 every month and putting it towards your retirement or putting it towards your debt. You can do a lot with car payments. So just something to think about. Number 6 is consolidation. Perception: compiling my debts into one smaller payment is easier management, but reality is you're just moving it around. Some people even put their home at risk by consolidating as part of a home equity loan. The behavior towards borrowing and overspending hasn't changed, just where your money goes. So just something to think about, that it's not always the quick fix that's the best fix. Number 7, friends and family, borrowing from them. The perception: they'll understand. They'll be flexible on payments and they will co-sign for you. The reality: now that they are at risk too, and it jeopardizes the relationships. The borrower is a slave to the lender. Just a personal story here. I have a client who they borrowed $50,000 from their family member for the down payment on a home. But in hindsight, that is now becoming a relationship strain where they feel indebted to this family member, but it's not a healthy financial relationship. There's nothing in writing. There was no agreed upon return of money date. There was no expectation set. It just has created some stress and some anxiety there, when really, when you try to involve money and friends and family, it can get a little sticky at times. So it's best just to avoid it if at all possible. You don't want to do that to your friends and family, and you don't want them to do that to you. The goal is to get to a place where we can give people that money that they need, not expect it to be repaid to us. All right, number 8, the 401k loan. Borrowing from retirement. Perception: this is smart because I'm paying myself interest. But the reality is you are putting your retirement at risk. If you leave your company, you have 60 days to pay your loan back, or you could pay taxes and fees of up to 40 to 50%. If you separate from your company, you might have to repay that loan immediately. So it's just another quick fix, a 401k loan, that doesn't really get to the root of the issue of how you got that debt and how you can pay it off, versus just taking money from your future and risking your retirement. Number 9 is the easy way out. Perception is that you can take an easy way out by hiring someone to handle all of this, and they will do a better job. Reality: no one cares more about your finances than you. Credit counseling: they say they can negotiate better, and you simply pay them a monthly payment. But debt settlement companies are not always what they are made out to be. One client I had paid an agreement that they had, and turns out that the debt settlement company wasn't doing their part of the job, and then her paycheck ended up getting garnished for what the difference was, and no warning whatsoever. So I just say that as a word of caution, that if you follow the advice of a debt settlement or negotiation company to stop paying your bills, you probably will incur late fees, pay interest charges, and fall further into default. And some of your creditors may even file lawsuits against you or garnish your wages and your bank account. So basically, the title of this one is, it's better to handle your finances yourself because you care about it and you're not trying to make a profit off of your misfortune. Our last topic is bankruptcy, which is a very complicated topic, but it has a lot of, approaches you can take to it. But the perception is that filing bankruptcy will solve all of your problems. It's a reset button and a fresh start. But the reality is that filing bankruptcy will stay with you for the rest of your life. What can a bankruptcy not do? It cannot discharge federally backed student loans. It cannot eliminate IRS debt. It cannot eliminate criminal restitution. It cannot eliminate alimony or child support. It does not deal with the spending habits or lack of communication or lack of income. It's not a quick fix. And in the case of Chapter 13, there is a 3 to 5 year repayment plan that goes along with the bankruptcy title. So overall, it is a very complicated approach to wiping the slate clean, when in reality, it may not wipe it as clean as you think. And then you still have to probably make some payments on that later on. So those are 10 perceptions for you to be aware of. How they are marketed, and hopefully you feel somewhat more educated about them. Do your homework before jumping into any decision. Talk to a coach. That's what we talk about and study on a daily basis. Don't buy into the perception that debt is good. So I'm going to just take a break right there because that was a lot of information for those 10 topics. If there's any questions that relate to that, that would be a great time to maybe bring those up before we move on.
Lindsay, you mentioned just now talking about working with debt management companies and even debt collectors. And we did have a question that was sent in about what's the strategy for maybe negotiating with those debt collectors, even if it's older debt. And you might be getting to that later on, but I think that was one of the ones that kind of related to what we were just talking about.
I'm not going to talk about it in depth anymore, just because it's a very complicated subject and it's very personal. But yes, there are guidelines for dealing with past creditors. There are when to call, what to say, how to say it, what steps you need to take. I actually am working with a client right now. We're working on four debts that are in collections, and it's a work in progress. It's not an easy fix, but sometimes you can get the settlements in your favor, or you can get something in your favor, but you have to go into it pretty educated and pretty sure of what your boundaries are as a repayment structure. And that's something that basically you can do on your own, but you really do need a script. You need guidance. You need to be able to know what the creditors are thinking on their side versus what you're thinking as a consumer and paying that back. Their job is to make money. Their job is to take your money, and you're trying the opposite. You're trying to give them as little as possible to settle this debt in full. So if that's a question that you have, my email will be at the end of the presentation. If you have something that you'd like to work through like that, I'd be more than willing to work with that. It is a little bit more sticky in that everybody's situation can be different, and all of the credit collections companies are different. So I hope that answers that question.
Yes, absolutely. And I think we found in our work with alums, even just having somebody on the phone with you while you're having those conversations can be really helpful to kind of boost some confidence and make sure that they're hearing the same thing that you're hearing. So
it definitely is. I think also it shows that you've come prepared, that you are ready to play ball. And that's not something that the collection side of it is always prepared to hear.
Absolutely. Absolutely. So having a financial coach on your side like Lindsay could certainly help here. We had another question. Could you talk a little bit more, expand on what you were saying about wage garnishment?
Yes. So, and again, that's a broad topic. It can be garnished for lots of different reasons, but basically when a debt is due someone and they are not getting it in a timely manner, they have the legal right to garnish, meaning take stuff out of your paycheck in order for that debt to be repaid. Sometimes there's an order of garnishments where a certain company or like federal, like the IRS might take priority. If you have back taxes, we'll just use that as an example. You can say, you can do the proactive approach, which is say, I want to make a payment plan. I want to talk with you guys about this. I want to be in control of this debt repayment. The other option is if you are not in communication, they can say, well, that's fine, but we're going to get our money anyway. And we're going to take it out of your paycheck, $100, $200, $300, $400 at a time. whatever the percentage is that they decide is okay. They have every legal right to take it. Your company has to honor that, and you will never see that most likely until you see it on your pay stub that says you were garnished for $300 per paycheck. Then, it might be for a year, it might be for 5 years. It just gets really stressful because it's something you are not in control of.
Yeah, thank you so much for expanding on that. It's absolutely something that is stressful if our debt has kind of gotten into that place where our employer is actually getting pulled in. So I appreciate you expanding on that. We have a few more questions, but I think you'll probably be covering some of the topics as we go. So I'll hold off on asking them for right now.
Perfect. All right. Well, we'll just keep on going, and then we'll have another little break and go over what we can.
Great.
All right. So we're going to move forward to perception versus reality. It's kind of a graphic of that stress meter that we're talking about. Look at the gauge on the left. The perception is that you borrow more money to get more stuff, your happiness will increase. But the reality is that the gauge on the right is probably more real. The reality is that your stress that increases with borrowed money and debt. Your happiness does not increase, but your stress will. I can tell you right now, from going from paying thousands of dollars in debt payments each month to being able to use that money for something that is beneficial to me and my family, the stress level is down drastically and happiness level has increased monumentally. I can't say enough for that sometimes it's okay to go against the norm and go against what society tells you is happiness. More stuff is not necessarily that, but experience could be. So you're just kind of having that trade-off. So we're going to look at the next one, what is called, what is blocking you? We realize for some of you that you're facing stuff out of your control, like a death in your family, a divorce, a job situation. There's tons of things that we can't control. But when your life settles down, the steps that I'm going to share in a moment will work. Right now, the other 90% of you, it's time to get to work. It's time for a behavior change. It's time for no more instant gratification. Always saying yes has got to stop if we want our futures to change. It's an example of training for something that is going to pay off in the end. You don't see Olympians saying, gosh, I only trained for 4 months and now I'm an Olympian. It's years of sacrifice, it's years of hard work. And that's kind of the same approach here, is that lots of stuff worth having takes time to achieve. And so hopefully we can give you guys some hope and some encouragement as we work on tackling debt, which we're going to look at now. So tackling debt, these are our steps. First and foremost, you have got to stop borrowing money. You can't borrow your way out of debt. That's simply digging a deeper hole. Along with no more borrowing comes education. Things like being aware of credit card offers, ads on television for debt consolidation, misconceptions, they're all around us. If you just watch a 2-hour program at night on TV, the amount of commercials for selling you something or credit cards or travel, it is amazing once you're aware of it, how much society is telling you that you should just spend. One of the things we're also going to talk about is starting and working on and doing a budget. That's another whole lesson I can teach on budgeting, which it's a detailed topic, but in order to be good and smart with your money, you're going to need to use a budget. Whether you're in debt, out of debt, or a millionaire, everyone works on a budget. If you need help, I'd be happy to visit with you guys one-on-one when we finish here today, and we can talk about that as a separate topic altogether. The third topic is the emergency fund. This is something that you set aside for the uh-oh moments. You will drop a cell phone in the toilet. You will have a car repair. You will have a sick kid or sick family member. Christmas does come in December, which is just 2 months away. Why do we treat all of these like they're an emergency? They are simply life. And having a plan to set aside an emergency fund, which we suggest is $1,000, into a separate drawer or bank account other than your checking or savings, is that comfort to know that if I need 4 new tires on my vehicle, I have that money sitting there. I do not need to put it on a credit card. I already have that emergency fund in place. Another thing is, nowadays you might have a doctor's bill or co-pays or all of these different things where if it's kind of out of the ordinary, this can cover you and help you from going further into debt. And that emergency fund is just a lifesaver in many, many areas. And then guess what? If you spend the emergency fund, you just replace it. You work on rebuilding that back, whether that's $500 or $1,000, depending on your income level. If you spend $100, put $100 back. Always keep that safety net so that you don't have to rely on a credit card. If one of these events comes along, we don't have to freak out and we get a little cushion between us and life. It's just so worth it. You can probably get to this emergency fund of $1,000 by selling things in your house or your closet that you don't need. Just get creative, and I know that you'll find a way to do this faster than you think. All right, so the next thing we're going to talk about is the debt snowball approach. And this, I don't know if many of you have heard of it. It is basically where we talk about paying off our debts in the smallest to largest in process. And this is a little bit different than, so there's this debt snowball method, which is this slow and steady, smallest to largest approach. Then there's other methods that have a interest-based approach. There's just some other things. However, we've found that the debt snowball approach is the most reliable, and you will be the most consistent with it because you're making steady progress that you can monitor, and you can actually see these little baby steps of progress every time you get something accomplished. You're more likely to stick with your plan when you have some rewards and some incentives along the way. So we're just going to flip through this, and it's simple math, but everybody's debt snowball will be different. So for the sake of time, this is just an example. So we're going to talk about this. We have our JCPenney, our Best Buy credit card, Fresh Start, which is like a medical repayment option. We have a bill, we have a family loan, we have a car loan, and we have a student loan. So you can see we have our total payoff amounts. We go smallest to largest, $350 with JCPenney. Down at the bottom, we have our student loan of $20,000. We have our minimum payments in that third column, ranging from $35 to $250. And then we're going to work on the debt snowball in the far right column. So our minimum payment on JCPenney is $35. Well, guess what? Once we can get that $350 paid off, we then would move that $35 and work on our Best Buy credit card. So our minimum payment on the Best Buy is $110. So we add our $35 minimum payment of JCPenney to our Best Buy of $75, giving us a new monthly payment of $110. So that looks like we'll get that paid off in about 7 months. Well, then next, we're going to work on our Fresh Start bill. That minimum payment was $150, but when we add our $110 to $150, you get $260. And you keep doing this until the goal is to make more than the minimum payment in order to get ahead of the interest and to get the debts paid off in a concise order that allows you to have those victories and keeps that momentum moving forward. It's just like if you were trying to get healthy and you were like, I want to lose 30 pounds. Well, it helps if every couple of days or every week you lose 1 to 2 pounds. It keeps you motivated. This is the same approach. If you waited and said, gosh, we're gonna try to lose weight, but we're gonna give it a couple months and then we're just gonna hope that we got it done and we lost that 30 pounds, you're probably not gonna stick with it. Whereas if you have those small victories, you're more likely to be consistent. So I'm just going to click through these and you can kind of see we're going to add these all together. Now we have a $360 minimum payment on that medical bill. Oh, sorry about that. I'm going to stop sharing. I think I clicked something wrong myself. Hold on 1 second. I hit the wrong key on my keyboard. I apologize. All right.
Lindsay, while you are repulling
Yes.
that up, we had a question from earlier that basically asked, I think what you just answered,
Okay.
what debt should I pay off first? And so it sounds like you're advocating for paying off the debt that has the smallest balance first.
Correct.
To
Yes.
give yourself some motivation of like, I did it and now I can continue moving on.
Exactly. And it's nothing more gratifying than taking that bill or whatever it is and shredding it, ripping it up, putting it in a file, saying, okay, that is done. We can move forward. And so yes, start with that smallest amount and use that as momentum and steam to work on the bigger, maybe more daunting amounts. But, if you have a payment that is a student loan payment, it's $20,000 with a $250 minimum payment, you can make a lot more progress, if you can add all of the other pieces to it. So instead of trying to tackle that first, where paying off 20,000 might take you a couple years or whatever that approach might be, it's easier and more encouraging to start with the smaller ones.
Great. Thank you so much.
Yeah. Okay. All right. So now I think I'm back and we're functioning, which is great. Okay. So we're going to keep going on this debt snowball. We now have a minimum payment of $460 on the family loan. And then we go all the way down to the car. And then look at this. If we did this and we're working this debt snowball, we took our student loan minimum payment of $250. Well, after some months, years, however long it takes you of hard work, that student loan payment now each month is over $1,000. So you're just expediting that payoff so much more by allowing yourself to be methodical. If you try to do too many things at once, you're probably not going to do anything well. So focus on what you want to pay off, accomplish it, and then move on to the next piece. So that kind of shows you, and we're just going to look at this debt snowball, and you guys can work your own debt snowball. Again, I'm happy to answer any questions about that. You send me your emails afterwards, and just because it's so personal and it's so different for everybody. All right, so we are going to look really quickly. Example, this is just the same snowball. So here's kind of the overall approach. With the minimum payments on these debts, it would take 9.5 years to pay off and get everything accomplished. By adding the snowball technique, it can be done in 3 years. Pretty amazing. Now, this add 500 line, I think it's pretty cool. So it said, what if you could apply an additional $500 per month to the snowball? Now you're debt free in just under 2 years. You just saved a year. And basically the encouragement here is dig, scrape, work to find any extra money to apply towards this instead of just meandering through the process. You're going to be like, where do I find extra money? Well, we live in a society where you can work as much as you want. You can do anything, basically, tons of things for, one person's service, another person has no problem paying for. So we'll have a couple of ideas here on the next slide of where do we find that extra money? And that's going to be our 5th topic, which is that right there. Okay, so here's some kind of, title headings of how to find that extra money. You can, number 1, adjust your withholding. If you are getting a substantial income tax refund in like February, March, April, then you are having too much held back from your taxes each month. The illusion is that it's a forced savings and you'll use it for catching up or a vacation or impulse spending. But the reality is that you have more faith in the government than you do in yourself to safeguard your money. It would be better to have a good working budget, utilizing the extra monthly income and applying that money towards debt. This is something to talk with, to look at your tax returns, really study what's being taken out of your paychecks. Don't just assume that a tax refund at the end of the year, beginning of the year, is the best thing, because that is an interest-free loan to the government where you could be using that money all year long to get out of debt even quicker. Number 2 is to adjust retirement. This is an area that will get resistance, but just, take a different look at it with me for just a second. If you can stop contributing to your retirement for 1 year or 2, and you were to become debt-free, the amount you are making in retirement might not even be compensating the amount of interest that you're paying. Maybe you scale back your retirement just to accompany match. Maybe you're just looking at it differently. Just remember that every day that you pay interest on debt is hindering your retirement in the future. So you might have a short-term setback in your retirement savings, but if you're getting out of debt, it will be worth it. So it's just something to look at personally and see if that's something you could adjust. Number 3, insurance. Quoting your auto and homeowners insurance annually can save you hundreds. Insurance companies bank on the fact that you don't want to do the legwork to get quotes or to work through the process of maybe switching insurance companies, because it's sometimes a pain, but you're typically overpaying for certain things because the company is banking on the fact that you don't want to do the work to maybe find a lower rate. And I have a resource for that if anyone's interested, but it's something that you want to look at. Just because you've been with a company for 10, 15, 20 years, or your family's been with them, or you know the insurance broker or the insurance agent, doesn't mean you're getting the best deal. So just do some homework and see if what you're doing is the best for you. Another thing is saving bonuses, gifts. Basically, anytime you get extra money that is not accounted for in your monthly budget, put it towards something that matters, whether that's getting debt free or saving for your retirement or saving for a set goal. Don't just be like, oh, let's go out to eat, let's go on a vacation, let's do all of these things, where if you could use it and just kind of harness that energy and that power of that extra money, you could accomplish a lot with it. And it doesn't have to be major, but you know, if somebody gave you an extra $100 for something, or you got an extra side job, put it towards something that matters and put it towards getting out of debt or a dream that you're trying to accomplish. Another example is part-time work. You can have a garage sale. You can take on another job. You can do anything you want. Work as hard as you want. Think of how that sacrifice for maybe a year or 6 months or whatever that timeline might be for you, that the freedom and the relief of being debt-free on the other end will be worth that sacrifice of your time. I can tell you, when we were working on our debt-free plan journey, that we were working 4 jobs, 2 each, and just, you know, every single piece of extra money that came in within reason, we were putting it towards our debt. And while it stunk at times for 4 years, I can't even tell you how it was worth it, and the freedom that comes on the other side. So the question is, why is it important to get your debt paid off as quickly as possible? Your why that we talked about earlier on is that reason. It's emotional, it's personal. It can't be the same for every person. So just remember that when you start to wonder why you're doing this, think back to your why and why it motivates you to do that. So we're going to talk about a little bit about growing your money. And basically, interest we pay is a penalty. Credit cards, student loans, all of the interest is a penalty. But interest you earn is a reward. We're talking about retirement. We're talking about your 401k. We're talking about, you know, long-term savings of your money. So I don't know about you, but I would rather be collecting more rewards than paying penalties. But let's just look at the next slide, and it's kind of it's a simple approach to growing your money. So we are talking about our monthly contribution, whether that's $100 or $500 or $1,000. And just to let you know, this is calculated at a 10% annual rate of return because it's easy math for presentation purposes. The stock market, your 401k, it can be all over the place, but for average purposes, we're going to do 10% here. So if we contribute $100 monthly, you can see how it'll grow $7,000 in 5 years, up to $76,000 in 20 years. So just imagine if you were, and there's calculators on the internet, you can plug this into, say, take all of your debt payments. So at the peak of getting out of debt, let's say you have $1,000 a month. Take that $1,000 and be like, okay, if I invested that, or I am just not paying it to debt, what would I have in my favor? So just to give you an example, 20 years is pretty average on a repayment of a student loan nowadays. Some are less, some are more. If you could take $1,000 and put it into an investment account, and you could come out with $750,000 after 20 years, how much more beneficial is that for you than just paying the minimum on a student loan and getting nothing accomplished, except paying for an education that you got 20 plus years ago? So this is just it's a simple visual. Another great resource that you can use too, not resource, but an example is taking the average car payment. We talked about that $460. That's that monthly, that's that middle line, $500. So in 5 years, you could have a paid for car that's depreciated its value, or you can invest and have $40,000 in your own pocket. So just some number of things to think about. All right, motivation. Hope is so very important. People I coach have simply lost hope because they lose sight of their why and they don't have those small wins along the way, like we talked about. We all need to win in order to stay with the program. Remember that those items you wrote down when we started, well, that's your why. That's what's important to you. And I gave you the how, so now I'm going to give you the hope. And I'm going to tell you a little bit of the story. So The Haydens, they were a young couple. They had some debt, both parents working full-time to make ends meet. Both had a burning desire for mom to stay at home with the kids. The dad took on another job and started working part-time. But the big piece of their puzzle was that they sold their brand new minivan after a little bit of struggle and a little bit of, conflict. And they used that extra money to buy an older van because their van had equity. It wasn't upside down. And they paid off their debt with the leftovers that was going to the car payment. And it didn't take them very long because they didn't have a ton of debt, but they had a ton of desire. Their work ethic was high. They didn't do anything earth-shattering, but they made a commitment and they stuck with it and they saw big changes. And as somebody who can speak from that example of starting out making maybe $100 extra payment a month to maybe, putting every ounce of extra money we had to something, and being able to get rid of these weights and these burdens that were hanging over us, the hope is just never ending when you start having these small victories. So the next slide, these are, kind of what we talked about earlier. It's the why. What can you do in the next month to get started? What can you do to hold true to these commitments to make a change? You could talk to your spouse. You could cut up a credit card. You could talk to a coach or a mentor. Write something down or, think about it where what can I do in the next month to change my, my financial future? So we're almost done. So we're just going to talk about the things we talked about, which is perception versus reality. We started today with talking about how you can have all of these tools and you're adding your why and you make commitments and you can really become debt free. It is achievable. And then the last perception is that you think the seminar is all that you need, but the reality is that this is a process and you need to have a support system and a team with you to learn how to work on your finances and win with them. And I'm going to challenge you to start, to have that fire lit and to really take this information and ask for help, ask for advice, ask for somebody to walk alongside you, ask for accountability, and work on your finances. It's not going to happen overnight. You can't leave your head in the sand and pretend it's going to just magically get better, but it is doable and you can accomplish that. So I'm going to leave you guys with this final slide, which is my contact information. I'm going to be more than happy to work with any of you guys that need anything. I do offer a free 30-minute consultation for all new clients so that you can kind of, get those questions maybe answered and see if coaching is something you want to dive in for a longer period or a longer relationship. And I would love to help any of you guys that have shown up today to just get that hope and that freedom of being debt free. And that is it on my end. If we have any questions.
Great. Thank you so much, Lindsay. I know that I sure learned a lot and I'm feeling really jazzed to get in there and take a look at my student loans. So we did have a couple questions and some of them, might just require a little bit more information about the person's situation, but I'm going to try to broaden them a little bit. Okay. So we did have one asking about, is there a cap as far as how old debt has to be? Do they have to pay something if it's, debt that's 10 years old, for example?
That comes down to a fun word of like statute of limitations, which sounds big and legal and technical, but it is. It's one of those things where each debt has its own story. And yes, there are some debts that a company might write off and they might not expect payment. However, you can't assume that, but then there's a fine line. It's kind of like the negotiating with creditors where it really comes down to that personal issue and what that story is. It requires digging, it requires information, it requires record keeping, basically to get all of the information so that you can make an educated approach. Because sometimes, example, you can contact a creditor and find out information or say, I'm going to pay you $50 and try to get something going. If you do that, your clock starts over again for the statute of limitations. So let's say that statute was 5 years. If you make a certain type of contact or a payment of any time, that clock resets to a new 5 years. So it's just a very, it's complicated. It is personal. It is company related. It's debt related. So it's one of those things where it would really have to be a full picture kind of dive to say exactly what the age limitation is on that debt.
Great. Yeah. I think you clarified as much as possible without knowing the ins and outs of this particular situation. So appreciate that one. We had another question, and we see this one a lot because I think it really kind of depends on the different types of debt. But this person is concerned about what happens to their debt if they were to pass away. Does it get passed on to their family? And they're also worried, about what their family members might be leaving behind that they might have to tackle after a loved one has passed on. So wondering if you could illuminate a little bit there.
So it is, it's a scary feeling to have that. I know. So I'll tackle the first thing about your loved ones. That is something where it depends on the type of debt. Again, it is very specific. If it is a example, certain student loans, depending on those factors, they will pass on to the next person who gets to pay them. So it is very complicated. It will require an open dialogue with family that you think, if it's your parents or a loved one, that you can have those open and honest communication with, that would help towards working to see if that's something that's going to affect you. It's one of those things where lots of stuff comes out of the woodworks when people pass away, good and bad. It could be that somebody has left you an inheritance that could change your life. It could be somebody who's, a co-signer on a loan that they defaulted on, and now you're having to pick up that slack. So it really is specific to that, that issue. But I will just say that you can't really do a ton with things you don't know about. So the more conversations you can have, the better off you're going to be. As far as your personal finances and what you are afraid of leaving to your loved ones or your children, I can only encourage you to get organized, to find out all of those pieces to the puzzle. Only then will you know, okay, I need to focus on this, this, and this so that it's not a burden. Another thing that can help cover those expenses is term life insurance. It's affordable for a lot of people, not whole life. This is term life. So example, married in their 30s, enough to cover, your debt, your mortgage, all these things. It can be as little as $25 a month. So it's just things like that where it's getting organized, knowing your debts, but also having a plan so that you can cover that in the case of an emergency. But yeah, getting debt free has many, many benefits to it. And one of those is knowing that you are leaving a blessing, not a burden, to those that you love should something happen to you.
Yes, so important. And I appreciate you bringing up the term life insurance because we have a presenter coming up in December who's going to be talking about estate planning for our alums, and I'm sure they'll be covering those pieces. So it all kind of ties together, right?
It does, yeah. It is basically saying, like, if you can get debt free, and then you can be working on all the things to build your life in the positive versus worrying all about the negative. It makes estate planning a positive experience in what can you leave to the next generation versus, oh no, what am I leaving them? I don't know, or I'm leaving them a mountain of debt and a house that's not paid for. So anything you can do now to get your finances in better shape will benefit you later on in many ways.
Absolutely. Lindsay, thank you so much for your time and your advice today. I think I can speak for everyone in saying that I think we could all benefit from having a financial coach like you in our corner. But we really appreciate you sharing our wisdom with our alumni today. I am going to turn it back over to Letitia to bring us home.
Yes. Thank you, Carolyn, for moderating today's conversation. And again, to our wonderful presenter, Lindsay, for your knowledge and expertise on all things that we really do appreciate it. I am dropping a link to a feedback survey in the chat that we would appreciate if you could complete. We truly value your feedback and want to know what we should be, keep doing more of and how we can improve. So that will be greatly appreciated. And no worries if you can't snag the link. We'll be emailing you all within 24, 48 hours with follow-up with the link to the survey as well as a recording to today's webinar. Also, we look forward to seeing you at some of our upcoming career and personal development events, such as our part 2 conversation that we had last year of Ask Me Anything, Let's Talk Diversity, Inclusion, and Race on October 28th from 12 p.m. to 1 p.m. Eastern Standard Time. And our Are You LinkedIn session happening also on October 28th at 5:30 p.m. And I get the pleasure of leading that. So if you like to just spend time with me, you can definitely come to that as well. And I am going to put the link to that in the chat as well. Give me a second so that you all can grab that and register for any of those upcoming events. Also, I did want to mention too, and I don't know, Carolyn, if you wanted to elaborate more, but I know that you all's office does assist and will take any alumni who would have any financial related questions as well. So please know that you can always contact the Financial Success Center at VCU with any questions that you might have that's financially related. So, on behalf of VCU Office of Alumni Relations and the Financial Success Center of VCU, we thank you for joining us today and have a great rest of your evening.